Today, our topic is related to auditing, and this course which we are starting today is auditing. The book we're going to follow for this course is An International Approach, Auditing as an International Approach. And the authors are Samuel Sask and Beverly Cavan and Cogileno and Brito. And the publisher is McGraw-Hill. So we're gonna talk one by one each topic, each chapter of this book. So let's start with the first introductory chapter that introducing the auditing and what is auditing and why it is required. So if we go over the learning objectives of this chapter, first and the foremost important thing what we're going to explain here is the importance of auditing. Why do we need auditing and what are the objectives of doing audit? Then we distinguish between the audit and accounting. So it's a huge difference between when you are auditing a firm or the financial accounts of any firm or the uh, accounting itself, because accounting is uh, preparing, or finalizing, and summarizing all the outcomes of the business. So explain the role. The third objective of this chapter is explain the role auditing in information risk reduction. So the basic objective of auditing is that the information provided by the accountants of the firm in the shape of financial statements. So this is the third party, or we can say that the party outside the one who is providing the information and the one who is getting the information. This is outsider who confirm or who reduce the risk of incorrect information, which is provided by the management or the accountants of the firm. So provide an overview of international auditing and its impact on Canadian auditing standards. So we also talk about the international accounting auditing standards, and what are their impacts on the Canadian auditing standards. So very similar like to the accounting standards, there are some auditing standards as well. So the role of audit is critical in the current business environment. Now, if we look at our economy and overall system of government or overall system of the society, we are living in a trust economy where someone provides an information and then we need an authentication of that information. For example, if you want to buy a house, what normally we do, we hire a lawyer or at least notary public to assess the documents of the property so that it is very clear that the titles of the property or the asset you are buying is clear. And then we do the deal. So it means we need someone to authenticate or someone who verify the information provided by the seller. Same is the case with the corporations and firms are that when they provide some information to potential investors or to the existing stockholders or other stakeholders in the financial statements of those corporations, we need an authentication that this information provided is free of any misinformation or there is no chance of misinformation. So what is the objective is that reduce the risk of misinformation or disinformation. So audit reduce the risk that these decisions will be based on inaccurate information. And why do we need information? We need information to make decisions. And when we have an incorrect information, so definitely the decisions based on those incorrect information is not a correct or a good decision. So for that reason, what we need an authentic information. So auditor provide assurance as to the accuracy of accounting information, and this creates a three-party accountability. In auditing, we define in auditing in a way that there are three parties involved. The first is the auditor itself. The second one is the one who is providing the information, or the management or the accountants, those who are preparing and providing the information. regarding the operations or business profitability or the assets and liabilities of the business. And the third one is the one who is getting those information. So this is why we call it as a three-party accountability. Auditing, the textbook definition of accounting is the verification of information by someone other than the one provided that information. So it outside party, third party verification. That's the important thing in auditing is. So uh, we are using an illustration to explain the importance of auditing. Assume you are going to purchase a business. For example, assume that you want to buy a business. Businesses are frequently valued using a multiples of earning. Assume that your business should be valued at a 5 times annual profit. How should profit be calculated? What amount should be included or excluded? And how do you trust accounting information provided? So the price is settled that the buyer is going to pay 5 times or normally 5 times or 7 times the profit the business has a capacity to earn. Now, how we can judge that how much profit is earned during the last year or a year before. So the financial statements. Now, financial statements are prepared by the firm normally itself, and then they allow the chartered accountants to verify those. Now, auditors are that after the chartered accountant or the CPA say that this is the correct information, but we need an auditor to evaluate that whether this information is provided is correct or not. So how do you trust accounting information provided by the seller? So we have to audit. The buyer and the seller should agree on the method of calculation of profit. And definitely every one of us, when we are dealing with an accounting or the measuring of the income of any business, we follow the generally accepted accounting principles. We call it as a GAAP. So GAAP provides a useful guidelines how to prepare a financial statement, what things we're going to add up into the assets, what things we're going to add up into the liabilities, what deductions and all these details are. We can get it from the generally accepted accounting principles. So has been determined by the third parties. There is no particular bias towards buyer or seller. So why we are hiring this third party? Because there is no biasness. So because seller is biased to sell it at a more price and the buyer is biased towards the to get it at a cheaper price. But how, who is going to assess independently without its own stake or its own interest in that transaction? So that is the third party, and that's an auditor. The seller of the business prepared the financial statements. The seller has a natural bias towards increasing income, which will increase the selling price. And the purchasers may not have the ability to check the accuracy themselves. The purchasers could hire a third party to verify the financial information, and this person would be the auditor. So under three-party accountability, the auditor is expected to act in the interest of the users of the information. So that they have to act in the interest of the users of that information, not the information provider. Because who is ultimate user of that information? Because one is preparing the information, the other one is using the information. The third-party responsibility is to verify that the information provided is correct. So to meet the public interest, it is important that the auditor is trustworthy. So we also talk about the auditor's capacity, capabilities, and all these things in detail in the coming slides. So when a task is delegated by one party to another agent, which is auditor, it can create a problem when there three conditions are present. Agency problem, or we can principal agent problem. The agent has a different objectives. That is a possibility that the agent has some internal or inner motives or objectives. So agent has the information and there is a room for the agent to be creative. So that is the possibility. The auditor monitor the agent, which is the management of the firm, like principal agent problem. Principal management is trying to prepare the financial statements, which is in their favor, and the owners are want to get a true picture. So how they can resolve it by hiring a auditor. Now, the in the beginning, we mentioned that we will differentiate or distinguish between the accounting and the auditing. So accounting attempts to record and summarize a company's transaction into financial statements for the benefit of users. So their job is to record and summarize whatever is happening in the business financially. Any transaction, a single penny is going out or coming in, any asset which is going in or going out, we have to record it. And then you have to summarize it in a way that is generally accepted all over the world and within the context of a country, so that the reader of the information get the same meaning what the you the maker is trying to. So accounting is the function of the organization's management. So management prepares the accounts of the firm. User are removed from accounting due to it is very complex scenario all over the year. The transactions are taking place. We are summarizing. We are recording and then we summarizing it. So it's a complex method, and the users cannot involve in it, and so that's why it is complex. It's not so simple to understand very easily, and it is voluminous, like thousands or even millions of transactions are taking place, especially in a retail business or a business where the daily they are doing the transactions of millions of transactions on daily basis. So it's not possible. The second thing is remoteness, that the management is on the site or on the business, and they have the control, they have the access to everything. But the owners don't have an access to all these things, or a potential investors don't have an access. So that's a remoteness, that they are away from the where the operations are taking place, where the activities are taking place. But the consequences are very important, different. Like if there's a loss, the management is just say that we have a loss, but the loss is bear by the owners. So these are the problems that we have to face. Audits lend credibility to the information by reducing information risk. The risk that information is materially misstated. Financial statements misstatements arise due to accidental error. That is also a possibility, that there's an accidental error, and the auditors that pointed out, and that's a good thing, that we can point out any error that is happening in the financial statement. The second possibility of misinformation or incorrect information can be a lack of a knowledge of accounting principles. Those who prepare those statements, they don't know the standards, and for that reason, what they are presenting is not the true picture. And the last one, which is the most lethal and which is the most problematic, is deliberate falsification, that the maker intentionally want to mislead the user. Audits do not directly address business risks, the risk that a company will not be able to meet its financial obligation due to economic conditions or poor management decisions. So that's not the job. Auditors to do not directly address business risks. Their job is not to identify the business risks. So uh, their job is to authenticate what the information is provided. So after this, now what we discuss, what is auditing, what is three-party responsibility, and also we discuss the uh, and distinguish between the accounting and the auditing. In the second part, we will talk a little bit more about the auditing, and the important thing what we'll talk about is that how the auditor report their observations, how the auditors report their final judgment. So we will see in this part.